Hello, I'm Ron Wilson. In this month's news, Australia's CPI rose 0.4% in the recent June quarter, according to the latest ABS figures, leaving the country's headline inflation rate at just 1% per annum, its weakest level since 1999. Meanwhile, the RBA has cut the official cash rate by 25 basis points to 1.5% in the wake of the low inflation numbers and uncomfortably high Australian dollar. And in international news, the Fed kept official interest rates on hold in July, the BOE eased in response to the weakening UK economic activity following Brexit, and China's GDP rose slightly to 6.7% per annum in quarter two. Michael Pollock has the details.
Australia's CPI rose 0.4% in the June quarter, according to the latest ABS figures. This followed a fall of 0.2% in the March quarter. This leaves Australia's headline rate of inflation at just 1% per annum, its weakest level since 1999. Meanwhile, underlying or core inflation was a little higher, rising by 0.5% quarter on quarter or 1.5% year on year. This reading was still quite low and likely to stay below the RBA's 2 to 3% annual inflation target, at least into 2017. The most significant price rises during the June quarter were in medical and hospital services, up 4.2%, automotive fuel, up 5.9%, and tobacco, up 2.1%. These rises were partially offset by falls in domestic holiday travel and accommodation, down 3.7%, motor vehicles, down 1.3%, and telecommunication equipment and services, down 1.5%. The RBA cut the official cash rate by a further 0.25% effective 3rd of August to another record low of 1.5%. The decision was reasonably well anticipated by the market given the RBA's ongoing easing rhetoric, with inflation well below the preferred inflation band of 2 to 3%, a high Australian dollar against a depressed euro and yen, and a US dollar which was holding firm as the Fed kept rates on hold. The RBA also seemed comfortable that lower rates would not exacerbate risks in the housing market based on the available data. The US Federal Reserve kept official interest rates on hold in July amid growing fears about weaker jobs growth and the potential impact on the global economy of Brexit. The Fed noted that since its last meeting, the US labour market has slowed while growth in economic activity appears to have picked up. Although the unemployment rate has declined, jobs gains have diminished. Against this backdrop, it decided to maintain the target range for the federal funds rate at 1/4 to 0.5%. The Fed's monetary policy stance remains accommodative, thereby supporting further improvement in labour market conditions and a return to 2% inflation. Support from Chinese authorities prompted economic stability in the second quarter of 2016, as government-sponsored investment remained strong and activity in the industrial sector accelerated. China's GDP increased 6.7% per annum in Q2, which was in line with the Q1 result and slightly above the 6.6% expansion that analysts had expected. The Chinese government has set a growth target of between 6.5% and 7% for 2016. The Bank of England has responded to signs of a post-Brexit slowdown by cutting interest rates for the first time since March 2009 and announcing additional measures to stimulate the economy. The UK base rate was cut from 0.5% to 0.25%, and the BOE commenced buying £60 billion of UK government bonds as one component of a broader quantitative easing program. The BOE expected UK economic activity to weaken in the near term, pointing to early indications such as the sharp falls in some measures of business and consumer confidence, and surveys suggesting that some businesses are beginning to delay investment projects and postpone recruitment decisions. The first significant data released in the wake of the 23rd of June Brexit vote was the UK manufacturing PMI for July, which fell to 48.2, down from 52.4 in June. Irrespective of the size of their accounts, approximately 50% of retirees draw only the legislated minimum pension from their superannuation balances each year. Further, a majority of all retirees display quite conservative spending habits, according to new research released by the Actuaries Institute Retirement Income Working Group. However, the research also predicts that as the population ages, there will be an increasing number of retirees who will exhaust their superannuation accounts prior to death by drawing down more than 10% of their balances. The 10th Household Financial Comfort Report, released by ME Bank for the 6 months to June 2016, found a marked deterioration in Australian households' confidence in their ability to manage debt over the next 6 to 12 months. This report provides in-depth analysis into the financial psychology of Australians based on a survey of 1,500 households. While a majority of households expected to be able to pay off at least a little more than minimum repayments on their debt over the next 6 to 12 months, of the 65% of households with outstanding debt, 10% anticipated they would be unable to keep up with the minimum debt repayments over the same period. This was twice the figure recorded in the previous report to December 2015 and the highest since the surveys began in 2011.